My name is Anthony Vicino, and welcome to the What the Finance podcast, where we interview finance, trading, and investing experts to help you understand current market trends and learn about the intricacies of new and existing assets. If you enjoy the podcast and to help with the YouTube algorithm, please like, comment, and subscribe. It really helps with the podcast. That means we can continue to get amazing guests. Thanks again. I hope you enjoy. Yep, Anthony, thank you so much for joining the What the Finance podcast to talk with me today. So just on to my first question, can you please explain about your experience and sort of how you got to this point in your career?
Yeah. So, to understand how I got to where I am, you got to go all the way back to when I was a kid and they diagnosed me with ADHD and they're like, you got some attention issues. And that really played out in a weird way for me in college because I went and got all these degrees, but I had no idea what I was going to do with any of it. And what was really clear at that point was like, I was a really bad employee. Like I was getting fired from like every single job that I had because I was like unfocused, undisciplined, and just generally I'm a lazy worker. So I think Bill Gates said it best when he said, I'd rather hire a lazy A player than a hardworking B player because the lazy A player figures out how to get the work done in less time. And I like to think that was me. I was probably more like a lazy B player, but for me, what that meant was I had to go off on my own path and figure out, my own way through the world. And that led me down a track where I was a professional rock climber for about a decade. And then through a confluence of events where a woman that I loved left me. And you know how that always like is the rock bottom moment in the movies where it's like, oh no, the fiance has left. And I found myself like really in debt. It was like $80,000 in debt. I was living in the back of a van. It was like not a great place in life. And a buddy of mine saw me in my plight and he's like, hey man, come build this business with me. And at that point, I really didn't have like an entrepreneurial bone in my body. I was not the kid who was plucking flowers and selling it back to the neighbor. Like that wasn't me. But he saw something and he's like, hey, let's build this thing. And so we ended up building a high-rise window washing company, which utilized our skill set pretty well as rock climbers. And then our network of rock climbing buddies who could get up there and do these jobs. And so what I discovered in that process is like, man, building businesses is actually really cool. Like I loved it. And so I've gone on now. I've built a bunch of different businesses to varying degrees of success. But in the last 6 to 7 years, I started building a real estate acquisition and management company. And specifically what we do is we go and we are focused here in the Twin Cities of Minnesota. And we go and we buy apartment complexes, big apartment complexes. And we do this by partnering with investors who take a passive limited partnership role. And the endeavors we go and acquire, we manage, we operate the assets. And that's been a lot of fun because you get to this point in your life when you're building businesses and you're like, this is a lot of fun, making a lot of money. That's really cool. But then you start to ask questions about impact and like, how do you leave a legacy and like living a life of purpose? And for me, real estate was really that, where we get to serve like 3 really cool intersections of customers, which is our residents, like people who want to live in these awesome communities, our employees who want to wake up every day and feel like they have a meaningful job and go out and like do something that impacts the community in a positive way. And then for our investors to be able to come along and participate in real estate where, a lot of our investors, they have no interest in dealing with toilets, tenants, and trash, but everybody knows like, hey, real estate has a really solid place in everybody's diversified portfolio. If you want to have a good hedge against inflation, you want to get those good tax benefits and solid returns, and you should be in real estate. But most people are like, I don't want to do any of the work. And so being able to provide that opportunity is really fulfilling for us.
Yeah, definitely. So you said there that you were like, when you first started, you weren't a very good employee. Did you just find that you sort of would get easily distracted? So you'd get interested in something, do it for a little bit, and then get interested in something else? Is that sort of what happened, or?
Well, what was interesting about it is I would do the job as it was technically defined. Like they'd say, do this task. And I would figure out how to do that task in 1/8 the time that they expected it to be done in. And then I would do nothing for the rest of the time. And so they would always come by and they'd be like, what are you doing? I'm like, nothing. And they're like, oh, you finished that thing. Cool. Show us some initiative and move on to the next thing. So I had no initiative when it came to working for other people because there was like this, this roof in terms of like, for my inputs, I'm not being proportionally compensated for my outputs. Right. And so that's a failure of my personality where I'm not going to work harder than is strictly necessary. But that took a long time, a lot of self-awareness. At the time, I was like, they just don't understand my genius. I'm getting all the jobs done. I don't understand why they're upset. Now as an employer, I can understand it. Like, yeah, that's maybe not the right type of culture or personality that you want to be surrounded with.
I do agree that there's not really that incentive, as you said, that why would I work harder or why would I be more efficient if you're just going to give me more work and no extra money for it when I could take the time to.
It's the curse of competency, right? Like
Exactly.
being better. And this isn't the case in all corporate environments. But the ones that I found myself in, it definitely was the case. And I was like, this isn't a good fit for me personally, where I I'm actually not that lazy when I'm really motivated towards the end state, like what I'm working towards, and I can see it having impact. And a lot of times in like a corporate environment, you're just another cog in the machine, and you really don't get clear visibility in like what you're doing and how it makes an impact at large. And so the default state then is to assume that what you're doing doesn't have purpose. And that's not a state that anybody finds very fulfilling. So for me, it took a long time to figure this out. Like at the time, none of this, I didn't have the self-awareness at that point, but with the gift of hindsight and being able to like, I don't know, gloss over and like repaint the narrative how I want to remember it now. That's how I choose to remember it.
Yeah, and it's what you said there. You need a purpose, be it if you're an employee or if you have your own business. It's just having that purpose that you're working towards, a common goal.
Exactly. And like for us now, we have probably close to 40 employees across all our different businesses. And like one of the starting points whenever we're hiring is, okay, how do we create a position where this person, they're going to be waking up every day excited to come into work and do this job because it fills them with purpose and meaning. And it scratches that itch of expressing their creativity or having accountability and ownership of a thing. And so we put a lot of time and energy into cultivating like an ownership mindset, which is really hard, right? Like all owners of businesses are like, oh, I wish my employees would care about the company as much as I care. And it's like, well, that's unrealistic. Like they don't get any as much of the upside. So why would they care? Right. And so, but you can do things within their positions to help them come in and like win at what they do. Because a lot of people don't want to be entrepreneurs. They don't want to build a business. They don't want to take on all that risk. And that's cool, but they still want to have a fulfilling existence. Right. And we spend so much of our time at work that I think it's our duty as employers, like to try and provide that, like to create an environment where people actually come in excited to do the work.
Yeah, and I think that's super important for any successful business. So let's go on to, I know you have a podcast called Multifamily Investing, and a lot of what you do is multifamily, real estate investing. So why do you see that as a strong investment for the future?
I think historically you look at the track record of multifamily and it's always been strong. Even in 2000, 2007, 2008, in the financial crisis, everybody thinks of like real estate as being risky or dangerous. And they always cite, the financial crisis. But if you look at that, you have to realize like not all real estate is created equal. That was definitely a situation that affected the global macroeconomic situation at large. So everything got hit. But largely, multifamily assets did not decline in value during that period of time. And we saw less than 1% foreclosure rate. So if you compare that to the single family home market, is drastically different. That market got destroyed. But multifamily, largely what happened was a lot of people got displaced from their homes, and then they suddenly entered the renters pool. And so really what we saw was increased demand in apartment complexes, but at that point with lower and high unemployment rates and people not necessarily being able to afford higher rents, what we saw was rent stagnation during that period. For like a 2 to 3 year period, rents just kind of leveled out and then started ticking back up, but we didn't see like a large loss in value. So that's one thing, is understanding that multifamily is a fairly recession resistant asset class, because as people lose their jobs, as they start to downsize, where are they going? Well, they're going to apartments. And what we're seeing is actually, it's really interesting. Millennials are in like the younger age group, like they're increasingly moving towards this world where they don't want to own a home. Like they don't really buy into that same American dream of like, oh, you got to go buy your single family home and have white picket fence and a dog and 3 kids. They're like, no, why would I do that? I want to rent. I don't want to own these things. I want to be able to leave it when I don't want it. So like Airbnb and Uber are perfect examples of this, right? Where people are like, I want to have the flexibility. But what's also really interesting is on the backside of that, the largest demographic of renters is actually boomers, people who like their kids don't want to inherit their homes. They don't have any interest in that. So the parents are like, what am I doing with this? Like, it's bigger than what I need. So it's time to downsize so I can go live my life. And so they're moving into apartments as well. So we're seeing increased demand on both sides, and we're seeing cap supply. especially in the target where we focus, which is workforce housing. So like class B, class C assets that you can't build that new and be competitive on rent. And so it's a fixed supply with increasing demand. And so we like that. And then you could look at all the other reasons just beyond, like, we always like to mitigate the downside. Like if you take care of the downside, the upside will take care of itself. So we always look there and say, is this a good solid hedge against inflation, good solid hedge against recession? And then does it also provide the upside that we're looking for? And largely it does, through the tax benefits, through the cash flow and the appreciation. Because what you have to understand, and what a lot of people don't get about multifamily assets, is that they're valued like businesses, unlike single family houses, where it's based off of comparables. So it depends on like what the neighbors sold their house for is going to largely determine what your house is valued at. And that's why during the financial crisis, all these houses suddenly went upside down, because collectively the market said, oh yeah, we were under a delusion, they're not really worth this, they're worth this, and everybody lost value. Whereas with multifamily assets, they're based off of the NOI, so the net operating income, which is a derivative of the revenues minus the expenses divided by some capitalization rate. And so if you are running a profitable business, that's what the bank is loaning against, that's what the debt is structured against, and that's what the value of the building is derived against. And so run a good business and you'll be well rewarded. And so that's, in a really big nutshell, why we like multifamily.
Yeah, definitely. And so you define multifamily as like apartment complexes, obviously more than one property in the building. Is that sort of what it is?
Yeah. So technically the cutoff point is 5 units and above. And the reason that we use that distinction is because below 5 units, it's a different financing structure. And so you're using a residential loan product, and that is based off the comparable structure rather than off of the income valuation model. And so above 5 units, it's a commercial loan. And we like to find products that are like 20 units to 100 units, because you get this inherent stability as you scale. So if you have 100 units and a tenant moves out, you're still collecting 99% of the income. That's great. If you have 5 units and one of those tenants move out, well, suddenly you're 20% vacant, and that's maybe going to put a dent in your profits for that month.
Yeah, definitely. And you sort of mentioned something there about, Uber and, let's say, Spotify, Netflix, all these things. There's almost like a sharing economy, subscription economy, where people aren't really interested in ownership. They're more interested in, paying a monthly fee or something like that. Mm-hmm. Do you see, so you're obviously looking at the property market similarly, where in the future it's going to be lots of renters and not as many owners of these properties?
Yeah, I think so. Like that's what we've been seeing in the trend in the last 5 to 6 years. And I think it's only going to continue to increase. I don't think there's going to be a fundamental shift in the mindset of young people. I'm not seeing it at the moment. And with boomers, it's just going to increasingly, this is what you tend to see as people age out, is they move into like senior housing, which is just another form of multifamily, just a little bit more niche. But I don't think that there's going to be a fundamental shift in how people view the world. And this is becoming really interesting with, NFTs and tokenization, and increasingly moving towards this ease of fractionalization ownership, where it's like, hey, I can own a piece of that thing without having to own the whole thing. So there's a very interesting argument to be made that in a 10 to 15, 20-year horizon, people aren't going to be owning their single family homes. They're going to be collaborating and tokenizing it with their entire family. And everybody's going to own like 1/10 of their parents' home, and in an interesting way. And so I think that'll continue to play out. As I think the marginal utility benefits of owning just don't outweigh the benefits of having the flexibility and renting it. Now, if you want to own the asset as a cash flowing generating asset for an investment purpose, I still think there's going to be a high demand there. But people just buying their home for the sake of living in it, I think is not becoming outdated, but I think more and more people are becoming disenchanted with that model.
Yeah, and you can link it to society. People want to be able to move wherever they like. They don't want to stay in the same place for long. They want to travel more, experience more. I guess you can link that to that as well.
Exactly. Like you rewind 30 years ago, kind of pre-internet and pre-connectivity. I would say a lot of people, they came out of high school and college and they never really left the state. They never really left their rural region, and they had no reason to expect that they ever would. And so lay down some roots and stick it out. But then, everybody's becoming so much more connected, and the globe is so much smaller now that people are like, why would I stay here? The world is my oyster. I can go wherever I want to. And we're really seeing people that play out on a large, I'd say lifestyle trend, where people are like, I can work remotely. Like definitely in the last year, we saw a huge explosion in that whole movement where now people are like, I don't even need to be tied down to a physical office. Huzzah. And people are, employers are taking to that as best as they can. Largely, they're like, it would be great if we could find some hybrid model where we still have people in the buildings, but the employees themselves largely are like, yeah, this is awesome. I love being able to work remotely.
Yeah, definitely. And so with this strategy, obviously you said you're treating it like a business with cash flow and, owning these properties for a while. Is there a strategy for selling them in the future, or is it more just holding on to them, getting the cash flow and keep reinvesting that or giving it back to
Yeah,
investors?
killer question. So specifically the model that we utilize is called the value add model. And what we're doing is we're specifically looking for assets that are underperforming for some reason. And remember, we can increase the value of our buildings in a very controlled way by increasing the revenues or decreasing the expenses. So if we can go and find an asset where for some reason the rents are below market, this could be because it's an old, tired owner who's owned the thing for 30 plus years and they're just not driving rents. It could be an inept owner that is just not doing great work. It could be outdated units for whatever reason. We're looking for something where there's a delta between in-place rents and market rents. And so if we can go in there and make improvements on the property level to maybe like the flooring, the finishing, the appliances, so that we can justify a rent increase, now we're driving more value into the building. And so we do that through a combination of increasing the revenue, decreasing the utility expenses, making the buildings more efficient. And as a result, what that does is it drives up the value of the building. So in a 2 to 3 year horizon, once we've done that transitional work, we go back to the bank, do a cash out refinance on the new valuation of that building. We take the proceeds of that, which is usually about 50% of our initial investment capital, return that to our investors. We don't use that as a buyout event. So everybody still maintains the same ownership in the building, but now they've de-risked their position. They have less capital in, but they're still generating the returns because we still own the building. And typically we hold buildings for a 5 to 7 year horizon, because at about 5 to 7 years, the buildings need to be refreshed. So all those unit level upgrades that we just did when we first moved in to like increase those rents, it's time to do another capital expenditure deployment. And at that point, it typically doesn't make a lot of sense from a IRR perspective to go and do that work ourselves. It's better to leave that meat on the bone for prospective buyers who can come in with a fresh cap table and do the whole model again. So that's typically what we're looking as a 5 to 7 year hold.
Yeah, definitely. That's super interesting. And do you see, you mentioned working at home and potential hybrid. Is that a risk as well for people, especially if they're investing in cities and potentially places that, people might be trying to get out of? We saw it I think people are going back to New York and Chicago, but we saw during the crisis, people were leaving quite quickly. And
Yeah, I think what's interesting about that is the people who can leave do leave. And so we did see a bit of a crunch in the Class A market where like white collar workers who like to live in the cities because the restaurants are awesome, the amenities are there, and it's close to proximity to work. Those were all great reasons. But now that you're remote, the restaurants were shut down for the last year. We saw a lot of people moving out into the suburbs, but by and large, those were people who could afford to move out into the suburbs. The people that we like to serve is that Class C, Class B workforce housing. So those blue collar workers who can't afford to leave. They're kind of landlocked within the urban environment for, financial reasons, but also those jobs really aren't going to leave. Like you can't outsource or remote work the types of jobs that those people are doing in terms of service industry work. And so we're not really seeing a crunch on that side, but we definitely are on the higher end new builds luxury apartment models, which we don't typically like because there's not a lot of value to be added into those buildings. But the thing is, like, on a long enough time frame, the things that make the cities desirable places to live, those are going to return, right? Like the restaurants, the culture, the energy, the proximity of serendipity, we'll say, like those things all occur for a reason. And COVID put a big damper on that because nobody was allowed to go outside and utilize the city as it's been designed. But the city itself is man's greatest invention. If you really think about like all the positive impacts that living in a city has manifested for humanity, it's like the best invention ever. And so I don't think those things are going to go away. New York, yeah, it sucks, but it's still New York. People are going to move back. Same with San Francisco. Yeah. Tech, it's expensive, people leaving, but it's still there for a reason and people are going to move back at some point.
Yeah, definitely. I think that's a super interesting way to look at it. So what would you mentioned sort of the Class B and C. So you're saying service people who are maybe aren't at the top tier of employment? Is that sort of the type of people they are, or what? I know it's very generalizing, but
Yeah. So the way to think about this is Class B, Class C. So your Class A building is like new build. It's luxury, something that went up within the last 5, probably 10 years. It's brand new amenities. It's in the hottest spot in the city. Class B is one step below that. Still really great neighborhoods, maybe even in the hot neighborhoods, but the building's like 20, 30 years old. So it's getting a little bit more run down. There's a bit more CapEx. And so people who can afford that top tier, they're going to go there. And people who can maybe afford that, but maybe can't, but they still want to have nice living in great neighborhoods, that's going to be one step below that. Class C is one step even below that, where still good neighborhoods, close proximity to good schools, but the buildings are getting older, a little bit more run down. And so really that price point, let's say in our market of Minneapolis, Class A single, like one bedroom, would probably rent for around 1,800, maybe 2,000. A Class B would rent for about 14 to 1,500, and Class C would rent for about 11, maybe 1,000 to 1,100. So you can get like an idea. That's going to put the median income at about 40 to 50,000 for that person. So that's like a teacher. These aren't slums. Like Class D starts getting you into like some pretty rough neighborhoods and rough work classes. Like, I don't know if I'd recommend that, but but the thing is, like, there's a lot of really quality work out there to be done that just can't be done remotely. And so that's the type of stuff that we're looking for.
yeah, and I know I'm in the rental market, and some of the properties that you see, you just can't believe that they're on the market, like to stay to them. So I know there's definitely a lot of opportunity for people to come in, and you're just looking around, you're like, oh my God, what is this place? But they just probably need a few $1,000s or pounds, and then they'll be able to get a lot more rent, I think.
Exactly. A little bit goes a long way. This is the other thing. Like, we love serving the Class C and Class B space because it's so easy to outperform the competition, because like Class A tenants, they're used to having like immediate maintenance requests and like amenities that galore. But the Class B, Class C tenants, they're more used to getting ignored when they have, a plumbing issue. And maybe it's going to take a week or two if the air conditioning goes out. And like, I was a renter in that demographic for the majority of my life. When I was younger, I was a college student, and like that's where I was living because that's what I could afford. And it's frustrating when you're like, hey, this is my home. I live here. This is my my safe place, but somebody else technically owns it and is responsible for it. So there's always like this frictional relationship between tenant and landlord. And one of the things that we try to do is try to understand and be empathetic to that strange power dynamic and try to exceed their expectations by delivering a great product. And that usually is just by understanding and responding to them timely and doing the work that we would all expect our homes to have. Like, hey, my toilet's overflowing. Let's get over there immediately and fix that. Hey, your sinks, like your washer and dryer is not working. That's frustrating. Let's fix that. Like, I wouldn't want to deal with that. So, but in this space, largely I would say the barometer for quality is low. So it makes it really easy for us to like trip over the bar and still exceed expectations.
Yeah, as you said, you just need a little bit more money, just a little bit more effort, and people really appreciate it. Then you keep the good renters.
Exactly. And that's like the number one like business advice I was ever given when I first started, was to recognize that a dollar saved is worth more than a dollar earned in a business, because the dollar earned is always on a margin. So maybe you're a rock star and you're on a 50% margin. So for every dollar of revenue you bring in, you only keep 50 cents of that. But if you can reduce $1 of expenses, that's straight value to the NOI, right? And that's hugely valuable. So when we go into these assets, we're trying to minimize trauma and expenses as much as possible. And one of the most expensive things to do is to turn a unit once a tenant leaves and to get a new tenant in, and marketing that. So if you can just go the extra mile to retain your customer, whether that's real estate or any other business, and increase the lifetime value of that customer, that's going to pay massive dividends in the long run.
Yeah, definitely. So what would you say are the most common mistakes you see people who are, maybe first time real estate investors in multifamily? What are the most common mistakes they make?
I think the big one is this assumption that real estate's always appreciating. It's always going to be worth more in the future than it is now. And generally that's true. Like on a 50 to 100-year horizon, you're probably right. But I don't know how much good that's going to do you in a 5-year window. And so, especially in the last 5 to 6 years, it's been a really great market. It's been hard to not make money. If you could just throw money at any building and just hold on to it for a little bit, you're probably going to do well, regardless of how well you operated the asset. And I think that's given a lot of people false confidence into thinking I'm a good investor or I'm a good operator, but you've never really been punched in the mouth. And until you have, like, it's Mike Tyson's quote, right? Like, everybody has a plan until they get punched in the face. And so I think a lot of people are flying a little bit closer to the sun, and they don't realize that their wings are melting because the market has been kind of protecting them. It's been a cloudy day, so to speak, and those clouds are going to go away, and then the wings are going to melt a little bit faster. So you just have to be diligent in your buying parameters and making sure that you're buying with a healthy enough, I would say, delta between in place and expected pro forma. And that's the mistake I think a lot of people make, is they're not going in there with the expectation that we can get these rents. They're going in with the expectation that the rents will continue increasing or something nice is going to happen in the future. And that's always a mistake. I think generally the best investors are the ones that assume tomorrow is going to be worse than today, and they plan accordingly. So that means keeping more in reserve, mitigating maybe some of the upside for the sake of protecting that downside. Because at the end of the day, like, we're generating, like, we've never had a project that didn't generate north of 20% IRR, but we have never projected that to our investors. At best, we project maybe 17, 18%, because we're holding so much in reserve, and we're saying, hey, we don't know what's going to happen. A lot of things could go wrong. And we'd rather, under promise, over deliver, rather than come in the other way and say, hey, we're going to deliver 22% and only, show up with 20 at the end, because that's still great, but it leaves a sour taste in your mouth when you're like, well, that's not what you said you were going to do.
Yeah, definitely. So are you seeing lots of people maybe over leveraging, sort of getting the properties that are too big for the capital they have? Is that sort of what you're seeing? Or
I don't think that it's necessarily a matter of being over leveraged as much as it is they're not going to be able to justify the returns they're projecting to their investors. That's the bigger thing, right? Like, you can go in there because the banks, they know they're valuing these things based off of the NOI as like a function of the income, right? So they're going in there and making sure that there's a healthy debt service coverage ratio. And so they're not super concerned that these things are going to just fail to perform and cover the debt service. But there's a difference between what the operator is projecting to their investors and saying, hey, we're going to be able to deliver this 20% IRR, let's say. Well, maybe you can't. But that doesn't mean the asset's going to utterly fail, but it will fail in the eyes of the investors. And so there's like two classes there that you have to be cognizant of. One, I don't think there's going to be, like, a lot of people were expecting with COVID that there was going to be this huge run of foreclosures and there's going to be like this buying frenzy. And I think there probably will be something similar to that in the single family market. But in the multifamily market, I think it's highly unlikely that we're going to see a huge correction in prices, because at the end of the day, it's still just a function of the business quality. And the bigger question is, how are you justifying the capital that you're raising? Like, what's the cost of that capital? And I think a lot of people are buying things because they're projecting better returns than they will ultimately be able to deliver.
Yeah, definitely. That's super interesting. And I guess you could link it, as you said, the market's running quite hot, especially over the last year. We've seen in real estate, massive boom. And you've also seen asset managers sort of buying property for as much as 30 to 40% above the listing price. So do you see this as a healthy trend for the market, or do you think there might be a bit of a correction soon? What's your opinion?
I think real estate is so local, hyper local. And so it's going to depend market by market, and you have to keep that in context. There are definitely some areas where the value, the purchase prices just can't be justified based off of the going in numbers. I think there's a lot of euphoria. And so anytime you're coming in and buying things 30 to 40% over what was initially listed, there's some question marks about what the strategy is. But then the other part of that is to realize that there are very different types of investors getting into the pool. And what are they trying to achieve? That's always number one, is like, what's their desired outset? Because what they're doing doesn't work for what we're trying to do, but it might work for what they're trying to do, which is, hey, we don't care about generating large returns. We want a safe inflationary hedge. And when it comes to an inflationary hedge, it's going to be hard to do better than real estate in the grand scheme of things. A nice physical real asset that also increases with the cost of living, like, that's hard to beat. And so if you're looking for a 2 to 5% return, yeah, you can afford to go in there and pay a ton of money. No problem. And there's plenty of institutional level investors and foreign overseas money looking for a place, and they're happy to have a 1% yield. And so, like, Is it overpriced for me? Yes. Is it overpriced for them? No. Does that mean there's going to be a correction? Probably, but I don't know what that looks like. I don't know on what time frame it looks. So I think it's just a question of doing what's right for you in your particular project and understanding the risk and return variables.
Yeah, definitely. And as you said, yields are so low in a lot of other assets. You look at bonds, you look at everything else, that these companies are just if it's just a little bit more than that, that's all they need.
Mm-hmm. Yeah. And then the other part of that too is like the tax benefits that flow through to the investors on the back end. Like, heck, like I can get a 3% return and the depreciation to offset other passive income. Cool. Like, sign me up. And then I can 1031 this into a future asset and not pay any of the capital gains. All right. Like, there's a reason our Andrew Carnegie said that 90% of millionaires are made so through real estate. Like, there's a reason for it. And so it's a very advantageous investment class. Does that mean there's going to be another bubble? I don't think there's a bubble. I think we look at markets and they're always increasing in these fits and starts, and we haven't seen the fits in the last decade. So I think we're overdue for a little bit of a fit, but I don't think it's going to be like this massive overcorrection that's going to destroy industries. Now with, what's happening in China and Evergrande, like who knows, like some crazy things have happened. I don't know how that'll really play out in the grand scheme for US side real estate, but that could have some devastating consequences in China for sure.
Yeah, and I guess you look at BlackRock or Blackstone, they're $1 trillion plus asset under management. They can get loans for so cheap. So for them, it's the same.
And they're in buying mode too, right? Yeah. Like, I like to pay attention to what the smart money is doing. I assume that those guys are a whole lot smarter, have information. And granted, we probably would have said the same thing in 2006. So take this with a grain of salt. But generally, it's wise to take a play out of what the other people, like the bigger players, are doing in the space, and just observe how they're moving. And the BlackRocks, they're gobbling up real estate right now, which is actually creating a big issue, because how do you compete against a BlackRock when they're willing to take lower yields, have like practically their cost of capital is practically zero? Like, that becomes very difficult to compete against. And so there is a question of, like, on a long enough time frame, a lot of these assets are going to wind up in the hands of a very few number of players. And that's the consequence of like all industries. You look at the number one and number two leaders in any industry, and they usually control like 80% of it. And the remaining 20% is picked up by all the stragglers. That might be something that occurs in not the too distant future if BlackRock has their way.
Yeah, well, I know in the UK, there's lots of banks. One of the banks, they're looking at owning 5,000 properties. They're thinking it's better for us to actually own it and rent it out rather than, giving out loans. And there's a few, there's a supermarket as well that has lots of properties. So they're trying to, it's almost like the strategy for people to become profitable, that they're investing in real estate, which, you could link as well to the sharing economy that we mentioned before, where people are just happy to rent, and they want new builds basically that provide them with the best up-to-date stuff.
Exactly. And it's just becoming harder and harder, I think, for a lot of people to compete in that world. And there's another interesting conversation to be had about the fact that a lot of young people these days don't really find real estate all that interesting or sexy. It's their parents or their grandparents' investment vehicles. So there's like, oh, Bitcoin, crypto, NFTs, way cooler, way more interesting, and leave everything else for the boomers. And so there's becoming like this little bit of a gap, it seems like, with the younger generation and their interest in real estate, because they don't really see it as being the accessible vehicle for generating the wealth they want on the time frame that they're looking for, which I think is really just a failure of education. I think if more people realize the different ways that they could get involved in real estate and that it could play a lucrative role in their goals, then I think we would see a lot more interest. But I mean, that just means less competition for us.
Yeah, well, I know myself, it's easy just to be very impatient and want to, make those millions real quick, but it's about understanding the long term that, only 0.001% of people actually do get that. So you have to be smart about it, I think.
Exactly. And like what I always say is that real estate is the best get rich slowly but surely plan out there. Like, if you just buy real estate and hold on to it forever, you're going to do really well on a long enough time frame. But most people don't have the patience for that. And I think that's the big knock against real estate, right? It's a very liquid asset. And I think we're seeing some really interesting things with tokenization that I think will probably change that in the not too distant future, to make real estate transactions so much more seamless and quick and easy to get in and out of, which I think is going to do wonders for that market. It's still a little bit of a ways out before I think it's going to be like commonly adopted and become the mainstream way. But I think there could be a revolution of real estate and how it's transacted here in the not too distant future.
That'd be pretty cool. So you can just buy, put a few $1,000s into buying a percentage of an apartment block and then get a dividend of, the cash flow. I think that'd be crazy.
Exactly. For us, like our minimum investment threshold is 50,000, just because from an administrative standpoint, like it doesn't make sense for us to take on investors smaller than that. But recognizing that most retail investors, they're not sitting on $50,000 just ready to go and put it into an illiquid asset that's going to generate cash flow and tax returns, but it's going to be locked up in that vehicle for 5 to 7 years. So like there's work to be done there still to make real estate even more accessible in the same way that stocks and bonds are for people. And once we can bridge that gap, I think if anything, that at that point, I think we'll see another boom in valuations in real estate. So buckle up.
Yeah, you lower the barriers of entry, more money can come in. It's what we've seen in the stock market over the past year or two with Robinhood. Mm-hmm. So, it's the same thing that I guess we're seeing quite a few other markets.
That's exactly right.
Yeah, perfect. So there's sort of this common notion of location. How important do you think this is, especially for real estate investing?
I look at it as every deal there's 3 aspects to every deal. There's the operations, like who is the team that's actually running this thing. There's the deal itself, and then there's the market. And generally I tell everybody it's the operator. That's the most important aspect. That's the most important thing that you're really looking for, because like a rock star operator is going to take a lemon deal and turn it into lemonade. Whereas a terrible operator, they're going to take lemonade and they're just going to spill it over the floor. So you need to get into bed with the good operators that know what they're doing. They have a track record of success. So that's number one. But, and then the deal, a lot of people focus on that initially and saying like, oh, show me those returns, show me those sexy, sexy numbers. But the problem with that is like numbers don't lie, but I can make them say whatever I want them to say. And so if you don't trust me, if you can't trust that, then you can't trust my numbers. So let's just put that aside for a second. But assuming you have a great operator and you have a great deal, if you have a terrible market, it's all for naught, right? Like the operator could be Michael Jordan in 1996 with the Chicago Bulls, and the deal could be they're rocking Nikes. They got the best equipment, they got the best team. But if the market is that they're playing on Mars, well, it doesn't matter, right? Like they're dead. Like it's not going to do you any good. So location really matters a lot. And if you put them in the right environment, they're going to thrive. And that's the thing with markets that I think a lot of people overlook is like, if you're in a market that has positive economic tailwinds and is moving in the right direction, it's hard to lose money. But if you're in a market that's stagnating or going the opposite direction, God forbid, like you can make money, but good Lord, it's so much harder. The question becomes, why would you do that to yourself? So I'm a big proponent of finding both macroeconomically, like looking at MSAs and cities that are doing well and trending with population growth and income growth and all these things that we look for, but also zooming in on the neighborhood level and recognizing like, if you live in a city, you know that there are certain blocks that you don't go to that you would not invest in, and that there's other blocks that you very much would. And sometimes the difference between those 2 blocks is literally just one street corner. And if you're not from that area, you don't necessarily know where that street corner is. And so there's this additional risk to investing remotely. This is why we focus exclusively in our market, is because we have intimate local knowledge here. Like you can't beat us on our home court. We know which streets to avoid. We know which buildings on those streets to avoid. And so, yeah, location is everything.
Yeah, definitely. So we'll go back to sort of people who are looking to invest in multifamily homes. What due diligence would you recommend people do? I know it's quite a basic question, but is there any tips you'd give people?
Yeah, I think you're going to spend a lot of time talking to the operators first and foremost, making sure, like understanding one, what's your investment goal as an individual? What's your risk tolerance, your risk appetite? What are you looking for in an investment vehicle so that you can go into the conversations with operators and actually figure out, is what they're doing going to get me to where I want to go? Because there's a lot of different ways to make money in real estate. You gotta pick the ones that work for you. And so you're going to spend a lot of time vetting for, integrity and track record and competency, and looking back at like, what have they done in the past? Is what they're looking to do in the future similar? And so doing background checks, getting referrals, like recognize that because these are really illiquid assets at the moment, you're getting into a relationship for a 5 to 7 year horizon. That's like a marriage almost. Like it's easy to get into, hard to get out of. And so spend the extra time, be diligent, recognize, like for us, the time between when somebody first becomes aware of what we do and the time when they invest with us, it's usually a year and a half of getting comfortable in conversations and seeing not just what we say, but seeing how we act over an extended period of time and looking for that consistency of behavior. And, we just wrote a book on this topic, Passive Investing Made Simple. And it's designed for people because most people aren't aware that this is even an option for them, is to passively invest in these things. And in there's a 65-point checklist of questions to run through with operators so that you can make sure that like everything is in tip-top shape. Now, you're not going to ask every single one of those questions, because unfortunately in the market that we're in currently, capital is easier to find than deals. And so we need investors a whole lot less than investors need our deals. So you can't afford to go in there and be a real pain in the ass, especially if you're, bringing in the minimum investment amount. But you do want to make sure that you're getting your questions answered and that you feel comfortable moving forward, because it's that know, like, and trust thing, which I don't totally agree with, because like, I know my brother, I like my brother, I trust my brother, I would not give my brother money. Right. And so there also has to be that fourth quadrant, which is like, they can actually do what they say. They have the competence, they have the track record. And so that's what you're really looking for. I would rather not like you, but know that you can perform. And I would do a deal with you rather than liking you, but not being so sure if you can perform.
Yeah, definitely. Competence is massive, I think. So, Anthony, thank you so much for joining the What the Finance podcast. So my last question, what is one message you like listeners to take away from our interview?
This is an investing podcast. Ostensibly, you talk about finance. And so the best piece of investing advice that you'll ever hear is start soon, start early. When you're young, start investing, let compounding interest get on the right side of that and do its wonders for you. Now, I want to take that and twist it a little bit, because it's not always about investing capital, or at least money as you know it. I want to put in front of you that I think the most important investments that you could be making when you're young is social capital, into the relationships, the people around you, because on a 10 to 15 year horizon, if you can compound those deposits, they are going to pay massive dividends down the road, because the two best investments you can ever make is one in yourself and two in your network. So yeah, go invest in those stocks and those bonds and those index funds and real estate and all that stuff early, like kudos, but also don't get so caught up in your career and your work and what you're doing that you're not paying attention to the relationships and the people around you. Because at the end of the day, that's what this whole thing is for. Like it's to build a life, and life is made up of other people. So make sure that you do right by them.
Awesome piece of advice. Thank you so much. So if anyone wanted to hear more about yourself or the work you do, where would the best places to find that be?
Yeah. So go over to invictusmultifamily.com if you're interested in learning more about commercial real estate investments. Otherwise, you can find me at anthonyvicino.com. And like I said, we have that 65-point checklist. If you're interested in getting your hands on that, just shoot me an email. I'm Anthony at invictusmultifamily.com. Shoot me an email and say, hey, I want that checklist, and I'll fire it over to you. You don't have to buy the book. I'll do you a solid.
Awesome. Really appreciate it, mate. Thank you so much.
Yeah, no problem.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.